Time now for Inside Out. Joining us now is Kevin Mahn, President and Chief Investment Officer, Hinian and Walsh Asset Management. Kevin, let's start with just big picture here, your thoughts on what you're seeing in the markets.
Yeah, we've seen the market move considerably forward. I think they've run too high, too fast, factoring in the perfect execution of a soft landing by the Federal Reserve. And I don't believe we're there just yet. You might recall last year, Diane, when the Magnificent Seven powered 62% of the total return of the S&P 500. Fast forward to 2024, as of the end of May, it was 53% of the total return of the S&P 500. However, and here's the catch, if you back out Nvidia, it's just 21% of the market. So Nvidia is leading the stock market right now, and Nvidia will determine what investor sentiment is from this point forward, because we really haven't seen a great deal of volatility in the market thus far. There's been 117 trading days thus far this year. Guess what? There's only been 2 days when the market has moved by 1.5% or more. That's less than 2% of the time. So I do expect some more choppiness ahead, and perhaps those short-term bouts of volatility will create attractive entry points for investors to consider.
So besides volatility, where are you attracted? What segments of the market are most attractive to you?
Sure. And we'll start with AI, right? What interview would it be without talking about artificial intelligence? But I'm not going to talk about semiconductors and chips, at least for now. What I'm going to focus on rather are the data centers and the hardware tied into those data centers. From my viewpoint, data centers are the nervous system of the AI ecosystem. They store all the massive amounts of data and allow for all the processing of those algorithms that these chips allow for. One company that we like in this area is Digital Realty, ticker symbol DLR. They're a REIT and they have a yield of about 3.4%. And guess what? They just announced a $7 billion joint venture with Blackstone to build data centers across the world in cities such as Paris, Frankfurt, and the northern parts of Virginia. On the hardware side, how about a company called Vertiv Holdings, ticker symbol VRT? You know what they do? They supply the energy, the infrastructure, and the cooling solution to data centers. Remember, data centers run hot, and it's forecasting that data centers alone will consume nearly 10% of our entire country's electricity by the end of 2030. So companies like Vertiv can help supply the energy they need and the cooling solutions they need. The other two areas, Diane, are aerospace and defense and smaller cap biotech.
So aerospace and defense, talk to us a little bit more about why you like that sector. Obviously, these AI plays make sense, and especially with the growth and need for more opportunities for investment around AI. But tell us a little bit more about what you're seeing in aerospace and defense.
Sure. We know at this point in time that our own military and our own defense needs to be replenished, upgraded, and modernized. Now, where do you look for those types of opportunity, considering that there's going to be much more investment into those areas? Well, how about a company like GE, going by under the business of GE Aerospace right now? They actually are a supplier of uh, aircraft engines. How about another company like General Dynamics, a more diversified supplier? We also like a company like Northrop Grumman. We're particularly keen on their missile defense technologies. And of course, another way to play the defense area, L3Harris, as they supply the communications that we need with respect to our own military capabilities. So we think, to borrow from a sports analogy right now, we want to invest where the puck is going, not where the puck is right now. And the puck is going to more investments into our military to once again replenish, upgrade, and modernize our country's military warfare capabilities.
And speaking of where the puck is going, earlier you mentioned small caps. Where in small caps do you see opportunity, especially because small caps as a basket hasn't been operating at the same level when you think about where the S&P 500 is and the leadership that we've had in mega cap tech? Where are you seeing opportunity within small caps?
Sure. For a broad-based small cap, I really think we need the Fed to start embarking upon their rate cutting campaign, which may not start till later this year. But one area that we like within small cap, regardless of what the Fed does or when the Fed does it, is biotech. We've noticed a particular pickup in M&A activity as large cap pharmaceutical companies have excess cash on their balance sheet, are seeing their profit margins actually shrink because pressure from Congress to lower their drug prices and a lot of their large revenue producing drugs coming off a patent and now being subject to generic prices. Most of these large cap pharmaceutical companies don't have their own R&D divisions anymore, don't have a pipeline of drugs to turn to. So where are they going to find replacements for all that lost revenue potential? We think they're going to have to continue to be acquisitive. Where are they going to look? To these smaller cap biotech companies who are providing all the innovative healthcare solutions that society so desperately needs, whether it's gene editing, gene splicing, antibody treatments, technology such as CRISPR or CAR-T. That's the area that these large cap pharmaceutical companies are looking to invest in. And dare I forget, how about obesity drugs? We have one company in our portfolio here at Smart Trust called Altimmune, ticker symbol ALT. They're a very small cap, about $500 million in terms of market cap, but they're developing peptide-based therapeutics, including GLP-1, for the treatment of obesity. Now, you can't tell me that there's not a large cap pharmaceutical company out there that's looking now to get into the weight loss arena with an obesity drug. So a company like Altimmune might be very attractive to them to consider.
And any final thoughts on sectors or stocks that are worth paying attention to use your analogy when you consider where the puck is going? I'm particularly interested in hearing more insight on utilities and what you're seeing there.
Yeah, great area to consider right now is utilities. Obviously, as rates come down, utilities look more and more attractive considering that they pay very high, consistent dividend yields. And how about the need for energy across our country right now to power these data centers? One company we like is the Southern Company. They actually have a yield of above 3%, and they supply electricities and natural gas solutions to around 9 million customers, including data centers. So another way to play the AI race is through utilities, believe it or not. In addition to that other company I mentioned earlier, Vertiv, which is in the industrial sector. So you're not going to only find AI opportunities within the technology sector. You can look beyond the technology sector in areas such as utilities and industrials and REITs to find pockets of opportunities to take advantage of all the money and all of the growth opportunities that exist within the overall AI ecosystem.
All right, that was Kevin Mahn with insight on finding pockets of opportunity and where the puck is going, whether we're talking about utilities, aerospace, or defense. Kevin Mahn, President and Chief Investment Officer, Hinian and Walsh Asset Management. Thank you. Our thanks to Kevin. Let's bring in Tom White, co-host of Fast Market, for some insight on a couple of the names that Kevin mentioned. He talked about GE, Tom. So what are you seeing in the option space for GE?
Well, it's had a pretty good rise, up over 60% so far this year. And I think if you take a look at their business, it's not only about, it's GE Aviation, right? They're basically selling their jet engines to the airplane makers. But one of the key aspects of why they've done so well recently is the contracts that they're signing for maintenance on those engines. So even though Boeing has slowed down deliveries, they're still delivering these engines. They still have to maintain them. So they have that recurring revenue based on that part of their business. That's why you're seeing the stock up over 60%, just below all-time highs that it hit just about a few weeks ago, over $170 a share. So I looked at something. They've got earnings on the 23rd of July. I want to avoid that event, right? Because that could cause some added volatility. But going into that event, there's a way that you can play this stock using the option market for a neutral type strategy where you think it's going to be range bound because it is consolidating right near its 50-day moving average as we speak. So going out to the July monthly cycle, so I've got about 3.5 weeks till expiration on this one where I'm going to sell an iron condor, but I'm going to use the same strike on the call and put that I'm selling on this one. So we sometimes call this an iron butterfly, a short iron butterfly. So going out to the July cycle, buy one of the 155 strike puts. That's to the downside out of the money. Sell one of the 165 call and sell one of the 165 put. So there's that common strike that you're selling, both the call and the put. And then the call side, buy the 175 strike call. So in essence, you're selling a $10 wide short put vertical, the 155, 165, and then selling a $10 wide short call vertical, the 165, 175. You're collecting a credit on this $10 wide short iron butterfly of about $6.80. So that's what you can potentially make. And you can see here from the risk profile, it widens out my break evens because I'm collecting such a hefty credit on this one. My break even's about 158.20 on the downside, about 171.80 on the upside. Now, that's about a little over 3% cushion to the downside for that break even. And then about a 5% cushion to the upside on this. And what this takes advantage of is some consolidation in the stock around that current share price, but then also positive time decay, or theta, works in your favor, where the price of this short iron butterfly contracts on a daily basis because of positive time decay or theta on this one.
All right, so that was GE. Meantime, you've got another example trade in Nvidia. What are we looking at there, Tom?
Well, I think the pullback, the 4% last week, gives people opportunities that maybe have missed that 150% gains that we've seen so far this year in Nvidia. So I looked at something a little bit different, going out to that same July cycle. But if you think this thing is going to return back to those all-time highs or maybe bounce from here, but you don't need a massive move to the upside, this type of option strategy takes advantage of it. I'm looking at a broken wing or skewed call butterfly to the upside in the July monthly series that expires in 25 days, where I'm going to buy one of the 123 strike calls, sell two of the 130 strike calls. That's where you kind of want it to go to. And then buy one of the 132 strike calls. So in essence, you're buying a bullish $7 wide call vertical within this, offsetting some of the costs by selling that 130, 132 call vertical within this this three-legged strategy. You're paying roughly about a 2.25 debit on this one, so that's going to be your risk, $225. But you can see here from the risk profile, as we get above that break even of 125.25 over the next 3.5 weeks, it's all going to be profitability, even above the 132, because I skewed this call butterfly. That break even just above 125 is only just about 1.5% above the current share price. So like I said, you just wanted to kind of grind back to levels that we saw early last week to be profitable on this one. But the apex of profitability you can see here from the risk profile is going to be at or near that 130 strike over the next 3.5 weeks.
All right, that was our very own Tom White with an example trade for Nvidia and GE. Thank you, Tom.
Thanks.